Welcome to CFO Chat, always your platform where you get all the insights as far as earnings are concerned. And we're delighted to have KCB Group CFO, Lawrence Kimathi. Glad to have you on set.
Thank you. Thanks, Julius. Always a pleasure.
Lawrence, let's begin from the bright spot this time. I know our conversations tend to begin from more challenging positions. NBK recapitalized and looking pretty good. But even saying that, I think the numbers reflecting a bit of a slowdown in terms of performance. How do you intend to position that?
NBK is compliant on all capital ratios, but as you've rightfully put it, quarter one was tough. NBK, actually in the Kenya market generally, liquidity was very tight, and NBK has had to go and borrow quite heavily, borrow quite expensively, and the cost of funds has really increased, and that has hit their numbers.
And still also at the group level, I know I was mentioning to you that performance went down. You told me, no, it's flat.
It is flat.
Please comment on that.
It is flat. So the performance is also impacted by what I just talked about, the Kenya environment in Q1. You live in this country, you know how things have been in Q1. So yes, we do have, we've spent quite a bit in interest expense line, just making sure that we've got the right level of liquidity, and it comes at a price. You know what they say, cash is king. Yes, so liquidity is king for the bank. It's about survival. So we really did have to go out there and mobilize liquidity, and it came at a cost, and that has impacted our performance. There are subsidiaries have done, international subsidiaries have done fantastic. They've more than surpassed the expectations. DRC in particular, the estimates that we had for them for Q1, they've more than surpassed that, and we believe that there's a lot more we can unlock in that market.
And also speaking about the DRC development, the OPEX is up higher than I thought, and I'd imagine that is largely on DRC expenses?
Yes, it is. It's not a like-for-like comparison. So you've got Q1 of TMB in 2023, it wasn't there in 2022. So that's really the primary driver for the OPEX.
I see. When we talk about asset quality, we had a conversation earlier this year around the special assets recovery. How is that going? Because still, from an NPL perspective, the numbers look quite huge.
The numbers are big. They make us uncomfortable. It keeps us awake at night, certainly for me and most EXCO members. But the progress is in the right direction. That the trending is right. Again, goes back to the environment that we are in. So there are things that you cannot execute as fast as you would in a much more conducive environment. That's one. But we have, what we set out to do in terms of recovery, rehabilitation, and write-off. We've done quite a big, I would say, a good percentage of that for quarter one was achieved. However, we also get some loans crossing over from the early alerts book into the non-performing side.
Okay. And I thought from a revenue balance standpoint, your non-funded income looks fairly good from a ratio standpoint. And I thought, given that you are now fully getting into DRC, are we likely to see now this gather more momentum going forward, considering how they play on that side from a non-funded side?
Absolutely. I mean, a 40% non-funded to funded, that's a ratio that we've talked about for a very long time. So we managed to hit it in Q1. And you're right that the contribution coming out of DRC has definitely helped, as other subsidiaries in the markets that we operate in. I would be untruthful if I didn't say that there's an element of subdued performance on the funded side that has helped that ratio, but nonetheless, I mean, we are quite delighted with the ratio at 40.
Okay, and Lawrence, even as we talk about recapitalizing NBK, and we've had this conversation before, when I look at your capital adequacy position, sometimes I get a bit concerned, Lawrence. I wonder how you feel about this.
So the headroom, yes, the headroom in Kenya for both core capital and total capital is narrower than we would want it to be. We are above regulatory limits. We've got a strategy to get back to the comfortable headroom that we've operated over time. But if you look at the trending as well, where we closed 2022, where we are closed in Q1, there's been an improvement. We had said we expect a much better improvement by H1 to get to more comfortable levels, and I believe we should be able to do that. Certainly by end of year, our headroom will be quite considerable. The power of the machine that is KCB Bank Kenya in terms of generating organic capital is amazing. Is amazing, and we expect that that will continue.
Okay, as we get to the tail end of this, one is that I am aware that KCB was heavily involved in the credit scoring for the Hustler Fund. We were supposed to have ratings ascribed to each borrower earlier this year. Could you comment on how that is going?
I think it's gone very well, and the project sponsor, the President of the Republic has been quite vocal about the success of Hustler Fund. From a credit scoring point of view, we knew what to expect, and to be honest, it's actually playing to the T of what we expected from the various risk buckets that sit in Hustler Fund. So much so that the fund itself has kept on going up and up in terms of increase from the sponsor. So we expect Hustler Fund 2 and 3 will come in and will continue being successful. I think it's a very good product.
Okay, and this has to be my final now, just because of time. We're discussing the issue of the capital requirements for Kenya, and out of interest on that point, we don't anticipate any changes from a dividend side. I know we've touched on this earlier before.
I mean, we will take a decision based on the information that will be available at that time. For now, we have not discussed changes, but come Q3, we will look at the capital position and take a call. The first decision we make is to protect the bank. Yeah. So we've got to have a long-term view on the bank. Opportunities come. Who knows? Maybe in August someone might come and tell us, we have this lovely bank here that needs to be acquired, and we go ahead and do it. So I'm not saying we're acquiring another bank, but I'm just saying opportunities come that we've got to balance. We definitely want to reward the shareholders. It's their business, but we also have to make sure that it is a sustainable decision we make. We're not making a decision today that in 3-4 years the bank will be struggling to make ends meet.